I'm disappointed. I wanted to celebrate Jack being back, but Crystal absolutely crushed it last week, and we had an intro. Now that Jack's back, our intro's gone. So all you have is me. So welcome to Pirates of Finance. We go live every Friday at 3 Eastern, noon Pacific. Let's start with the disclaimer. Nothing we say is investment advice. Seek out investment professionals. This show is for entertainment purposes only. As per usual, I got the man, Corey Hofstein, and working the ones and twos in the background without an intro is the young Jack Farley. So appreciate it, Jack. Glad to have you back. We bust your balls, but it's always great having you around. Appreciate you being back. And we got the band back together. But Corey, I'll let you kind of jump off of whatever direction you want to go in. I don't actually have any clue what we're going to talk about this week, so this should be fun.
I find that's often the best episodes.
Yeah. Well, but I want to start with whatever you've got going on behind you. I feel like you've set up a nice little studio here.
Do you notice what's behind me? I've been waiting. This is my secret. I told Jack, I was like, how long does it take for Corey to notice?
Oh, I noticed it immediately.
Yep.
Oh, it's beautiful.
So I've been hinting to you that this is a present for you as well, but you've been out of the country, so I haven't been able to set you one. And shout out to Spencer Brown Pern for creating this for us.
I will be back in the country immediately to get that.
Yeah, I've been. It's actually been at my house for a few weeks, but I've been away from home for a few weeks, so I was excited to get back, unwrap this thing just before the show, and get it up on the wall.
I love it. I love it. Well, let's dive in. Jason, you were at, I think, probably your favorite type of event to go to, which is a macro event this week. 2 days of pure macro insanity. I feel like that could risk bringing the energy down of this show because you just left it all out on the floor. You gave it all, everything you had this week, and now you're just tired. And I get it because you love macro so much. There's nothing you would rather do than spend 48 hours discussing macro views. So maybe let's start with what'd you guys talk about at this secret macro event that I wasn't invited to?
It wasn't a secret macro event, but yeah, shout out to Real Vision for doing the macro experience. And yeah, as you know, I'm not a huge fan of macro because I'm not a huge fan of narratives. I got introduced by Samuel as the consummate contrarian, and I was like, I have a terrible self-image because I don't think I'm a contrarian at all. So, but I get told that often, so it's always surprising. I just think I have a form of
the macro wet blanket.
Yeah, exactly. I just can't help but take the other side in that if somebody's steel manning an argument and straw manning the other side, I'm like, I had to steel man the other side just to make us hopefully negate each other and we get back to even. So that was a big part of it. The other interesting thing, I think, I actually was having a conversation with Alex Grievich, and on the side, he likes to write fantasy novels, and that's what he works on. So we were talking about that a lot, and I was like, forgive me for asking such a dumb question, which I'm always glad I ask dumb questions. Shout out to everybody that loves a dumb question. I know how much you love a dumb question. Alex said that the difference between fantasy and sci-fi is sci-fi takes the world as it is and then extrapolates into the short-term future, and then that's how they create a sci-fi, and then a lot of times they're not logically consistent. The difference is in fantasy, you have to create an entire world view. You have to build an entire world that's logically consistent, and then your characters can work through that entire worldview. And I thought that was a really interesting way to look at it. And then I couldn't help, but as I watched everybody present or panels and discussions, how many people are either using like a sci-fi approach or a fantasy approch, and both of which, though,
you need to expand on that because that's really interesting.
Yeah, I thought it was fantastic. So people are either going to take, they're either going to use like a Bayesian update of like, okay, here's my picture of the world. I'm updating daily. This happened today. Whatever happened with the Fed. This is my Bayesian update. And that's how they're going to extrapolate into the near-term future using the past. So it's a very Kierkegaardian view that we only see things through the rear-view mirror, but we have to drive forward. And that's what they're trying to do is like, okay, maybe drive forward into the near future. I'm just using my headlights, and here's where I'm guessing where I'm going. And then the fantasy view is people that can create an entirely sui generis, like macro narrative, and have a very distinct worldview of the way they think things work. And a lot of times they're doing their own work, right? So they've built up their entire thesis from the bottom up, like, and thinking about even what maybe textbooks may say about the Fed or interest rates. They don't necessarily take that as the way the world works. they actually create their own worldviews and they try to make them as logically consistent as possible. And that doesn't mean that, but what's fascinating to me is at the end of the day, we're talking about the future. So no matter which venue you choose, we're still talking about the future and nobody has a crystal ball. And it's interesting to me, like what you see a lot of times is people will throw out, 20, 30, 40, 50 prognostications about the future. And that way in hindsight, they can be like, I nailed it. And it's like, I've seen your 50 predictions every quarter and 45 of them didn't come to fruition. So,
well, so did Alex have a view as to whether one of those approaches was more fruitful when it came to macro? Because it seems to me like if you're in the fantasy camp and you're literally reinventing the world, you might be able to see things from a truly unique approach, but you also might be creating foundations that aren't actually there, right? You might be a completely fantasizing how the world works versus perhaps the more sci-fi approaches starting with, in theory at least, a picture of how the world currently works and trying to extrapolate from there. So did he have any views as to, or do you have any views as to which maybe is the more productive approach?
No, and I don't. Let me clarify too. I don't want to draw Alex into this. My craziness is that we were actually just talking about writing fiction. So it was a late night discussion about why he likes fantasy more than sci-fi, and so I just then couldn't help but extrapolate it into what was going on in the background at the event. And so Alex doesn't necessarily have a view on that. I was the one that kind of extended the metaphor, but I think you're right. I think both are fraught with pros and cons. It's just like kind of like which one is more interesting to your personality.
Got it. So this all leads me. Oh, Jack coming in for the interruption.
Jason, can you give me? I didn't really understand the difference. What is the sci-fi version and what is the fantasy version? Like if we're looking at
Dungeons and Dragons versus Star Trek, man.
Of course.
And, but Star Wars meets you in the middle.
But like in terms of the portfolio construction, like if someone has a view on bonds, like or thinking about inflation, like how would those two different practices look like?
Yeah, maybe a quick example, and this maybe isn't the best one, but I was just thinking about like MMT or monetary operations, right? You either have a whole worldview of how that actually works, or maybe you're using the textbooks that you learned when you were at B school and you're extrapolating from there. And so, that's maybe the more way I think about it. I'm trying to think of other macro frameworks too. Like there's some people that maybe we talked about last week that when you have a demographic overhang and you have large amounts of debt, a lot of people think that's deflationary and that continues along this disinflationary. But some people will build a worldview on how that could be like inflationary that maybe just not in the textbooks or what we've seen historically. And that's part of it too, I think, with the sci-fi view. And it was interesting. Alex didn't like necessarily the sci-fi view a lot of times because he felt it was logically inconsistent. And I was thinking about, whenever you see a sci-fi book or movie come out, and then like the true experts start coming out of the woodwork and they're like, that's just not possible. And so it was interesting is like, so it wasn't logically consistent with the science, but then I thought, man, how hard is it to create a fantasy world where the entire world needs to be logically consistent? Like the ability to hold that up throughout a book and to really, that's why Alex loved it. The ability to think through in the macro terms, how you have to create a logically consistent world. And basically you are the creator of that world. So it's almost like your energy is holding up that world. And I just thought that was a really interesting way to think about things.
Yeah, all the laws, the myths,
everything
that goes into it, right? The behavior of people, their mores, like all of that needs to be logical and based on some sort of evolution of behavior over time. Anyway, neither here nor there. I actually think a lot about that because you guys know I play Dungeons and Dragons, which is a big, fantasy evolution. But so you coming back from this event actually made me tweet something today where I basically said, because I'm sort of getting fed up with all like the hot macro takes that seem to be circulating lately. I'm getting like a little bit fed up with the hot macro being given without any insight into what this person's actually their personal account looks like, or like what the implied trade is. And so, like, to pick on the narrative du jour, it's the petrodollar trade, right? Which we talked about, I think, last episode or maybe 2 episodes ago. This idea that all the U.S. is going to give up its reserve currency status. All of a sudden, it's not going to be the petrodollar anymore. You're going to have the renminbi. I can never say that for whatever reason. That word's impossible for me, right? But you're going to see a change of guard, and we talked about this last time. And there's been a lot of people who've been getting a lot of radio time to discuss this. And the thing I never hear is, okay, so if this person has so much conviction in this view, show me the conviction in their personal account. And what trades are they expressing this view? What's the time horizon of those trades? Like, what's the maximum convexity way to express that? What if you're wrong? How are you risk managing that trade? And it's one of my biggest frustrations with a lot of this, pardon my French, macro masturbation. To me, it's like, it's great. We can discuss these things, but the trade is left as an exercise to the reader. But in the meantime, we get to come off sounding really, really smart, or because we have these fantasy creations, right? So it's just one of those, to me, it's like one of my pet peeves. Like, at the end of the day, just show me what your personal account is. Show me the trade. Stop telling me what you think is going to happen. Show me the bet you put on, because that'll tell me what you really think is going to happen.
Exactly. And Jack, are you getting Mike's breaking up a little bit here and there? I think we can still understand him just fine, but are you getting the same thing?
I am, but I don't think we can really do anything about it.
Sorry, it's stormy here in Grand Cayman, and whenever it's stormy, my internet sort of craps out.
Man, all I could think was like, how quickly can I get on a plane to go drink dark and stormies with you? Like, that's all I could think about on that one. So to extend what you were saying, this is why, and shout out to my buddy John Kitsamita that was saying that, we were talking about me being contrarian, and he's like, no, you're just agnostic to macro narratives. And I was like, yeah, exactly. Like, the narrative fantasy versus whether it's fantasy or science fiction, the point is we're talking about the future, and it's a narrative. And the point is they can be built so beautifully that you can't help but be susceptible to them. And I am. Like, it's just like, wow, that's an amazing, cognitive leap they made there. I love how they created that. But then to Corey's point is like, great. And this is why I love talking to Alex Grievich so much, because he's the same way. He's like, what's the trade? But even better, what I love about Alex is like, he creates, he has his narrative that he creates, kind of, like he does have a macro narrative that the lens he's looking through. But then if he cannot find a trade to express it properly, then he doesn't even take a trade. And that's what's interesting. One, he's looking for convexity or asymmetry. But more importantly, what's interesting is Alex doesn't like options. From being on the sell side selling options, he's like, it's obviously a great commission for the sell side. But more importantly is sometimes with that finer paintbrush, you can paint yourself into a corner of path dependencies. So Alex is looking for an asymmetric, and I don't want to speak for him, but an asymmetric trade that might be expressed in delta 1 instruments, because it opens up the distribution of path dependencies where he could still be right. Where, like, as you know, with the options, Corey, it's like you have to get multiple path dependencies right. You have to get all your Greeks right. You have to buy at the right implied vol. And even though you might be directionally right on your delta, you may not make any money. And so it's interesting. That's what Alex thinks about. So once again, it's like, what is the trade? Show me your PA. What's the time horizon? How are you expressing that trade, more importantly? And then what I get into that really bothers me is not that, are they right? Is not an issue. It's like they have a great idea. They might be right. They might have a trade expressing that. But I think about the relative value or emergent effect at the portfolio level. What if you're wrong? What does the rest of my book look like? And that's what gets me fired up, is not actually what people are saying at these events or whatever they're saying on stage. It's that if someone in the audience is drinking up what they're saying like hook, line, and sinker, and then they adjust their portfolio to the path dependency they're talking about, they're exposed to the myriad of other path dependencies that could just absolutely destroy their wealth over time.
Right. And it's a question of like, what's your conviction in the idea? It's really easy to get up on stage and pound your chest about an idea that sounds clever. But when you find out that they have a tiny little convex position and that the majority of their wealth is actually in a counter trade, right, that really speaks to their conviction and their ultimate skin in the game. I think at the end of the day, I hate to say it, but things like this are sort of free career call options. We can just banter online, and most of the time this stuff will just fade into the ether and no one's going to call me out on it in 2 years. And that's what you see with a lot of people who do stuff like this. They just or write newsletters. They're just constantly churning out content and then pointing back to where they're correct. And I will absolutely be doing that with pirates as well. I plan on monetizing my free call options, but it's one of my big frustrations. It ties into another one for me. And this is actually one of my sort of like, I have a lot of like, I don't want to call them Coreyisms, but I have a lot of like stupid catchphrases.
Well, we're talking about ourselves in the third person now, man. You are getting big time.
There's big ego floating around over here.
Yeah.
But you have a lot of people who over the last several years point to things in the market and they say, oh, the market's broken. It's so fundamentally broken. Like the Fed is protecting the market. This is all one big Fed pump. Or like the one that got pointed out a lot was when U.S. interest rates were higher than Greek interest rates. And people were going, whoa, what is the US debt? Is it the high yield bond of the world? This is crazy. And I'm saying, well, if it's so crazy, show me the trade. That's the only question you have to ask someone when they say the market's broken or something's broken or something doesn't make sense. Fine, show me the trade. Because if you went and looked at Greek debt versus US debt, yes, the nominal yield was higher. But if you tried to monetize that by expressing a bet that locked in your currency risk going forward, that disappeared.
Exactly.
Right? So it was all priced into the currency forwards. So it's one of those situations that's like really able to express that view, or the market's not actually expressing that view at the end of the day, because you've missed something. And when you try to work through what is the trade, often you find the thing you've missed.
Right, and that's that no arbitrage condition that's so difficult with FX trades, or as as soon as you go cross country interest rates, it's always difficult. And and that's what you're saying. There's different levels to this game. Yes, the nominal rates were different, but then you said when you tried to express the trade and you tried to hedge out your currency risk, like you realized it was a negative expected value. So the different levels of the game, and no shade to newsletter writers, but if we think about what's really going on behind the scenes, is the more outrageous things they can say on a quarterly basis, the more they widen their distribution of catching people to come in and be subscribers to their newsletters, because there's inevitable churn in the newsletter. So you constantly need to churn new subscribers. And so therefore it behooves you to have really divergent opinions, and you can have really unique ideas, because that's actually the point. And it's not about managing people's savings or building an investment portfolio. It's about having a unique set of opinions that will bring in more subscribers to your newsletter. And so that is a big part of it. I think there was a lot of interesting debate around, I think it focused on, is inflation here to stay? And is the dollar hegemony over? I think that was a lot of what the discussions were around at the event. And it was just kind of interesting that most people, it seemed the consensus opinion was on the side of inflation here to stay and dollar decline.
That actually is interesting, because a lot of macro people think that they remain in the transitory camp. I think, so as a macro podcaster, those newsletter writers, God, I mean, unlike us macro podcasters, but
you're for entertainment purposes only. Let's be honest. And it's very entertaining, and I love watching. I love it. So don't get me wrong, Jack. I love your show. I've watched tons and tons of episodes. I love watching this stuff. But like Corey's saying, what is your PA? And sorry to interrupt you, Jack. Go on. But I remember I gotta put Corey on the hot seat in a second, though. So.
Oh yeah, screw what I said. Go put Corey in the hot seat.
No, I want to push back, because Corey knows this. We've had an argument. I would say Corey and I don't argue. Discussion privately about whether hedge fund managers should have PAs, or that whether wealth managers should have PAs. Yeah, here we go. And so to me, I have a distinct advantage, so I'm cheating. Is like I can construct portfolios from a fund of funds level that covers almost every asset class and is really trying to manage multi-generational wealth. So that's why I don't believe in PAs, because if I had a PA that I couldn't figure out how to put into my fund, to me that's not fulfilling my mandate as what I'm supposed to do for my clients.
Yeah, your mandate is to be a total portfolio solution.
Correct.
I think if we take a big step back, my view is that holistically people should be building their portfolios with a view not just of their investment capital, but of their human capital. And people who work in the investment industry, particularly if you manage portfolios, tend to have a levered exposure to the market, right? You're more likely to get laid off in a bear market, though that's sort of true for the rest of the world as well, versus other industries where that might not be true. But if you say work for a tail hedging fund, well, it certainly doesn't make sense for you to have 100% of your money in that
Correct.
fund, right? And in fact, I would argue you would probably want to be very long and strong equity as a hedge against bull markets, which is going to have a very strong effect potentially on your human capital. So I think you have to model this stuff out. I've always said it in the context of myself personally, where I am the owner of an asset management firm who runs a fairly niche strategy. Certainly not a strategy I would ever recommend anyone have 100% of their money in. So I don't know why I'm expected to have 100% of my money in it. But on top of that, as a majority or 50% owner of my firm, right, that private equity ownership is levered to the revenue generated by the portfolios I manage. So now not only do I have my investment capital in there that's liquid, I have a huge amount of illiquid investment capital tied up in it, plus my human capital, right? If my own business goes out of business. So I'm like tied to my own portfolio at least 3 different ways, multiple which come with leverage in an implicit form. Like my private equity value is a multiple of the revenue generated by the assets I raise. And if the fund underperforms, great, I'm going to lose assets, right? So like I would argue that my ownership of my firm, because I'm still a boutique, I'm not BlackRock with hundreds of different strategies, I'm not diversified like that, should give me a somewhat of a pass as to how much, liquid assets I need to have in my own fund. But that seems to fall on deaf ears whenever I argue that to people. So
No, yeah, I was teeing you up. I'm joking with you, and I thought that was the answer was perfect. But it did make me think. You should say you're tying yourself to the mast. That's what we're both doing, right?
Yeah.
So in the pirate sense, we're leashing ourselves to the mast and we're riding into the storm, whether we like it or not. My point when we talked about this a long time ago was the idea that if there's a way that you can express a trade you want, then it behooves you as an entrepreneur to come up with a way for not only you to express it, but then also have access for your clients to express it versus trying to find, something that you can do privately. That's all I was trying to say. Is like, to me, it was, I just wanted more entrepreneurial effort from the finance industry to build the products that they personally want.
Well, this goes back, though, to another conversation you and I have had multiple times, is the products people want are not often the products that you and I might want. Right. So like you are building a total portfolio solution. The traditional distribution mechanism within asset management is to sell to financial advisors. And financial advisors typically do not want a total portfolio solution because they want control over the client's asset allocation. So they're looking for a fund that is a US equity fund. They're looking for an international equity fund. They're looking for some bond funds that fit different niches, high yield, core, aggregate, that sort of stuff. And if you bundle it all for them into a single ticker, they won't buy it. If you look at fund flows, multi-asset funds sell very, very poorly. They just do, because people don't want a single ticker. It's line item risk for both the advisor, and it seems to make individuals very uncomfortable as well. So, you and I have had this discussion a lot where it's like, it might be possible on the private side, but when you start talking about ETFs and mutual funds, where it's just going to show up as a single ticker for a client, those sort of multi-asset solutions just really aren't a good business proposition.
Yeah, and in fairness to I love our comment section, by the way. It's so good.
Yeah.
I keep laughing reading stuff while you're talking. Sorry, Corey. Like the 3x NEWFOUND ticker core for 3x Hofstein is so good for Brian. And then Trey made and Trey's piggybacking your point about the idea of imagine a long vol manager being 100% invested in their fund. And I agree and disagree in a way. It's actually funny. I've talked to a lot of times to the Artemis guys about this. Is like, if you're a long vol manager, you should essentially be getting, single family real estate or private real estate for like the highest LTV you can, right? Because your problem is you gotta basically an implicitly short GDP asset, with long vol. You should be kind of levering up long GDP as much as you can. So if you can get your bank to lend you, 100% LTV at the best rates, you should be buying the biggest house you can, because that's kind of how we offset a long vol fund. But the only caveat I'll give for that comment, Trey, which we appreciate, is that I think about holistic risk, and Corey's hinting at this, and we talk about this a lot. It's not just your portfolio, right? And so like entrepreneurs all the time will get, they'll get their savings and people just put it into, an equity or 60-40 fund. And now they have multiple leverage to equity beta because they're all long GDP assets. So, even if you're a long vol manager running, a long vol fund, you still have all this life entrepreneurial risk with your house, your car, your spouse, your relatives, your family. There's a lot of other long GDP risk that you could offset by putting all of your savings still back into 100% into a long vol fund. Once again, I'm not a contrarian. I just can't help myself.
Yeah, I mean, I think if I were, and I'm not a financial planner, but the way I try to think about some of this stuff for myself is I say, what does my human capital look like? And as an entrepreneur, it sort of depends on where the stage of my business. Like 6 years ago, I would say my human capital looked very different than it does today. And then I have my investment capital. But I think then the piece that maybe gets missed by a lot of folks is considering that future liability. right? I don't have kids, but I may one day have kids, and there's going to be a lot of expenses related to that. I don't currently own a home. I have in the past. I probably will in the future. There will be expenses related to that. There's a retirement somewhere in the future, right, that I need to consider the expenses related to, and I might model those as short bond positions of varying duration, right? And once you start to play with that, you go, this is really like an asset liability management problem, very akin to what a lot of pensions try to solve for. And this is my brilliant way of segueing into
Dude,
a
that was so
podcast
good.
I shared with you.
It was so good. I was admiring how good that segue was. Sorry, that was unbelievable.
Segue, taking the off ramp into a podcast I shared with you yesterday, with two of the CIOs of Fairfield County pension funds. That, I mean, again, you and I this is the funny thing.
By the way, just to correct you, it's Fairfax County, Virginia, right?
Oh, Fairfax.
And I just want a golf clap for Fairfax County, because their CIOs, that was one of the best CIOs interviews I've ever seen. And shout out to Alan Dunn, Top Traders Unplugged, for that podcast.
Yeah, it was a fantastic podcast. Ironically, I shared it on Twitter, and I think it's, of all my tweets in the last week, the least liked tweet that I had. So again, I guess all I can do on Twitter is shitpost. But go find it on my Twitter account. It is phenomenal. They talk about capital efficiency. They talk about stacking hedge fund beta on top of diversified traditional core beta. We talk about accessing crypto through unique exposures. One of the things I loved that they just said up front was they wanted exposure to crypto. They didn't want the vol. So they invested privately just to shield themselves from the vol, so they didn't have to report it to the board.
Yeah, well, they told the board it's a VC investment, which is accurate.
Which, again, like we sit here often saying, wow, these pensions are investing in private equity, claiming it's got lower vol than it really does because of the reporting lag. And, a bunch of pensions would say that's exactly what we're doing, because we kind of have to, because we're trying to manage the funding rate volatility, right? Or the funded status volatility. So I just thought it was a fantastic podcast. I want to kick over to you, get your thoughts, because I know you listened to it recently.
Yeah, there's a couple things I want to pull out of there. Obviously, we're highly biased because, like Corey is saying, it's a lot of return stacking, and they're using futures to get much more capital efficient leverage to like equity beta or bond beta. That way they could stack it with hedge funds doing global macro or relative value, et cetera. And so that was what was fascinating about the podcast, to like actually listen to a real money CIOs that can actually do that, because most of them aren't. And so that was really interesting, I think, for Corey and I. There's several pieces. I wish we disagreed more, Corey, a lot of times. And what always bothers me is we tend to pull out what we think is the most salient piece of a podcast, and we both found it to be the most salient piece. And the one I'll pull out that I found towards the end was that they just came up with a mark for private equity to a 25 vol. So instead of believing that private equity on their quarterly vol estimate, with that illiquidity and mark to model, they threw that out the window, and they just came up with a rule of thumb for themselves that they just pulled out of thin air. But it was great that they said private equity is a 25 vol, and then their private hedge funds, especially in crypto, are like a 45 vol. And so they assigned a vol number for them that was much more accurate than they were getting from their PE managers.
But does that recognize the huge skew in crash events? Like, are they updating the vol for S&P, their private equity vol, from 25 to 70 during March 2020?
Yeah. That's a great point. And what they did say, kind of related to that, because I was thinking the same thing, Jack, is that they hold a lot of cash with their capital efficiency too, and they were using that cash almost set aside for capital commitments to distress funds during a liquidity event. And that's kind of their hedge, is they were more using cash than necessarily they felt they couldn't find, and I would disagree with this, obviously. They felt they couldn't find put spread, or put spreads collars. I think they may have been looking in the wrong space to find those hedges, or figuring out how to attenuate it to their portfolio, or because their equity is moving around so much. But they did, and I love cash too. You want to diversify your diversifiers, but it was interesting to think about that cash was when you got that capital call from distressed. And that would help their compounding tremendously.
So I've had that exact conversation with some family offices around capital efficiency, right? So the idea of using leverage or futures or something like that to get core beta exposures to free up cash, not to invest that cash elsewhere, but for the exact reason that capital calls and a lot of their private investments are positively correlated to market stress. And so what kept happening is they'd get those capital calls and they'd be forced to sell their liquid assets during periods of market stress to invest, and versus just saying, actually, during those periods, we'd rather be levered, right? Take down some of that cash we were just holding aside, be able to send it to the distress, and then rebalance when markets rebound more fairly. So I think it's a really interesting use of capital efficiency that really doesn't have a whole lot to do with the return stacking that I talk about a lot with capital efficiency, but can be just as useful for people who are making investments into strategies that are going to have capital calls.
Yeah, and Jack, I want to go back to your question because I didn't answer it, but like what I love, obviously I love about what you're saying is what about the left skew of drawdowns? That matters much more than your Sharpe ratio. But they talked about that in there too. They were saying they're not optimizing for Sharpe ratio. They were looking at different return drivers and return streams. And then in fairness to them too, they're running a very conservative portfolio. I want to say Corey, correct me if I'm wrong, that their expected return estimates were like 6.5%. So you can imagine
and they were 6.75 down from 7.5.
Right. And so they were also saying, so part of that, Jack, though, was like assigning this vol of 25 over assigning a vol of 25 and 45 to like the private hedge fund stuff is what they're really doing is then they're reducing that position size with that higher vol. So even though the vol may blow out there, like you were referencing, which is true, the position size is so small. So they've actually limited their exposure via position sizing much more so than just trying to always move the vols around. And then they even talked about, was great too, is like when you're in a lot of these private assets or hedge funds and you're maybe getting monthly liquidity or monthly reporting, it's really hard to track that in real time, especially across a lot of line items. And so they weren't going to adjust that volatility, move it around like would you have like a vol targeting fund that was doing it like on a daily basis internally. You're not going to have a lot of those whipsaw effects that you would have. So they're just thinking much more longer term about it, and that gives you a different perspective.
The episode reminded me a tremendous amount of an old article from Cliff Asness from AQR, like it almost like line for line, like a playbook he wrote. So there's this article. It's a little hard to find. You can, if you Google the title, I think there's one PDF copy of it that I've seen floating around, and it's called 7 Thoughts on Running Big Money for the Long Term. All right, so I'll quickly run down the 7. The first is you have to embrace risk, right? If you want to manage money for the long run, outpace inflation, you need to take on some sort of risk in your portfolio. He says to survive in the long term, number 2, you need to brace yourself for the short term, right? So prepare yourself for drawdowns. Make sure you don't get your portfolio into an overly stressed scenario that you're going to be forced to capitulate, basically. 3, diversify your market risk as much as possible. In this paper, he explicitly talks about adopting global risk parity, which is exactly what the Fairfax pensions did. Levering up bonds to equal the same risk as stocks, and basically trying to maximize the amount of risk adjusted return from each beta to contribute equally to the portfolio. 4, seek out alpha in the land of beta. So basically what Cliff is saying here is if you look at a lot of like alpha sources, alpha hedge funds, like long short equity, it's just a lot of equity beta. And they mention that specifically in the podcast. One of the CIOs says they don't do long short equity because it just looks like equity beta. And in fact, they have one manager that they allocate to that's long short equity, and it's in their equity category. They don't treat it as an alternative. The alternatives they choose are CTAs, right? Which I thought was really interesting. Like they're trying to allocate to CTAs and relative value. It's my recollection of what they were choosing.
I'm sure you noticed, by the way, I get this question all the time about long short, and we don't believe necessarily shorting is the best way to express a long volatility trade. And we always talk about long short. I always put them in the equity bucket because they talk about their correlations with long equities. But the way they said it too in that podcast was that they feel like a lot of long short managers end out about net 60% long. And so once again, it reminds me of 60-40, where you're just reducing your equity exposure. So you're reducing the vol on the equity side is essentially what they're doing. It's just like just reducing that exposure is all you're really doing with the long short.
I would have to dive in to know how they're adjusting. My guess is they are making adjustments for that position and saying it's lower vol equity. And so they're sizing it up on a position size basis, but because they seem to have a pretty sophisticated look through into the position and how they're managing them. So just to finish out the list from Cliff, number 5, add as much manager alpha as you can find net of fees and factors. So this is true, in theory, true alpha. And look, these CIOs were very open to exploring what they thought were sources of alpha that they couldn't get elsewhere. I mean, they allocated to a crypto hedge fund that was doing things like crypto basis trade and cross arbitrage exchange. You don't hear that from a lot of other public pensions, right?
None.
So they're willing to adopt those sources of alpha, even if the fees are egregious, as long as there's positive alpha out there. Number 6, don't be afraid to take a contrarian view. Cliff here, I think, is talking about from a valuation perspective in this piece. I would argue Fairfax is doing something very contrarian to their peers, right? They're basically doing risk parity, stacking on top CTAs and relative value hedge funds. That looks almost nothing like what the majority of public pensions look like. And then the last piece that Cliff says is be innovative in combining market beta, hedge fund beta, and alpha. And again, I think that's exactly what Fairfax looks like they're doing. They've got their core risk parity global betas. They're stacking on top hedge fund beta, right? CTAs at this point aren't alpha. They're hedge fund beta. And then in rare cases where they think they can find alpha, like owning GP positions in certain hedge funds, emerging managers, like those are unique alphas that they can capture that other parties can't, and they're going to introduce those where they can. So it was really just fascinating for me to listen to this podcast and go, man, this is just echoing everything I read in this Cliff article back in 2009.
There's so many things I want to jump up because this is one of the things I wanted to ask you. One of the things also that came out of the global macro conference I did last week is defining terms, right? That's what's really important is like, what are we actually talking about? So, take the word transitory that's gotten a lot of press lately is like, what are we defining on terms? If we're looking at a century-long time horizon, well, 70s style stagflation was transitory, right? Most inflationary episodes are around 7 years. So if you're looking at a 100-year time horizon, that's transitory. But it depends
in the
on
long run, we're all dead.
Well, yeah, exactly. So once again, defining those terms. So what I find and what I want to get to is risk parity, right? A lot of people will strawman risk parity and they'll just use it as the stock bond portion of levering up bonds to your stock exposure. And then that's their straw man or their bugbear that they beat up on for risk parity. And so, when true risk parity, like what you saw in this podcast with Fairfax County, is having a broad diversification of return drivers, not just stocks and bonds, but using, commodities, using alpha generations that are the alpha generation that's tangential with different types of strategies, using privates, using publics, using liquid, using illiquid. So I just want to kind of like open the floor for you to talk about risk parity and to kind of straw man it in a way of like, it's usually, if you use global asset classes, it's very different than to just use stock bonds. Yes, if you're just using stocks and bonds and you're leveraging up the bonds, you have a lot of correlation risk that you're opening yourself up to, and everybody's, beating them up. That does make sense if it's just stocks and bonds. But that wasn't the original papers, impetus, all this stuff for risk parity. It was using a lot of different return drivers and a lot of different uncorrelated assets, correct?
Yeah, somewhere along the line, this risk parity concept got totally bastardized. And I don't know where it happened. I have a guess, but if you go back to the original papers and concepts from Bridgewater, the idea was to sort of break the world into 4 quadrants, right? Based upon inflation or deflation and economic growth, or positive economic growth and negative economic growth. Find the assets that do well in each of those 4 sort of combinations of quadrants, and then build a portfolio that balances across them, taking a long horizon view. It was not meant to be short-term, sensitive to market volatility. It was like very long-term, Harry Brown permanent portfolio-esque, just sort of redefining how you were going to find balance and based on these sort of economic quadrants. You then saw the quants come in and say, well, we can do this mathematically by looking at all these markets and finding their unique contribution. So we don't really have to say we think, emerging market bonds are in a certain quadrant. We can say mathematically how related they are to other assets and make sure that they contribute precisely the same amount of risk as other assets. That became a little bit more sensitive to volatility and correlation assumptions and how they changed in the market. But it was still global assets, right? Commodities, currencies, equities, rates markets, including stuff that's not just futures necessarily. Like you might have to access tips or emerging market debt. It in theory includes everything. And then somewhere along the line, my guess is in marketing presentations, it got dumbed down to say, look, if you buy a 60-40 portfolio, 90% of your equity's coming, 90% of your risk is coming from equity. If you want risk parity, you actually need to have like 80% in bonds. And I think people started to interpret risk parity as just stocks and bonds. And obviously, that's massively sensitive to inflation. And so people say, oh, risk parity is doing really poorly right now. No, it's not. Risk parity funds are having a phenomenal year. And everyone thinks they're having a horrible year. All you have to do is look up a couple tickers of mutual funds, and you can see they're having a great year because of all the commodity exposure.
Like, what are some tickers, Corey, that are that are diversified? Just
look up. I mean, AQR has one. AQ Mix. You could look up the Invesco Balanced Risk Fund. I believe Natixis has one. Panagora has one. I can't remember.
Yeah.
Off the top of my
Corey,
head.
I have been operating for a long time under the misapprehension of risk parity as just, I guess, 130% bonds, 70% stocks. And yeah, I can tell you, as someone who, here I'm talking my book, I like have some exposure to commodities, like that. Yeah, the commodities really have been a good ballast, to use a word that Jason likes a lot.
I try to use all nautical terms if I can. But you're right, Jack. And I wonder, Corey, if a part of that is like it's so much easier to get access to the liquid stocks and bonds. And that's why people tend to focus on that, leveraging up stocks and bonds, because it's much harder to access commodities and do it properly, or other asset classes that, people can't get liquid, low cost ETFs for. I want to point out, Rajiv said risk parity, fancy pants words for investing with borrowed money, but with a balanced portfolio. And almost couldn't agree more. But at the same time, like everything we do is using borrowed money, either explicitly or implicitly. But yeah, as if you have broad diversification, it doesn't really matter too much if you use it a little bit of implicit leverage versus, almost every other asset class you're in. If you dig down deep enough, it's levering up in some way on the balance sheet, at least, especially with equities. The other thing I want, sorry, Corey, were you about to jump in? I had one other thing from the podcast, or just it, Jack?
Oh, just Michael Harris, shout out for good comments. I said risk parity got crushed in 2008 bear market. What do they mean by that? They talk about the commodity. I know commodities had a huge bear market, but bonds were a pretty good hedge during 2008, right?
Yeah, I actually disagree
just during
with
Q4.
that.
Yeah, Q4 was when the bonds rallied.
Yeah.
So yeah,
and you did see a coincidental drawdown of equities, bonds, and commodities, sort of when you got that massive deleveraging. But in many cases, a lot of those funds had already de-risked. They'd taken a lot of leverage off because volatility was going up. I mean, you saw the same thing coming into this year. Like Q4, you saw rates vol go up, you saw equity vol go up, you saw commodity vol go up. So during 2022, a lot of risk parity funds had already cut a ton of their leverage down, like way below where it was entering 2020. You saw the same thing with a lot of risk parity funds in 2008. So there was a quarter where you got a coincidental drawdown, and that is the big risk to any sort of these types of strategies, is correlations go to one. But I'm not sure I would agree with Michael's view that they got crushed any more than a traditional global asset allocation got crushed.
Or SPY. So Jason, what were you going to say before?
Oh, there was one other thing in the podcast that I'll take a little bit of umbrage with, and they were talking about CTAs, and they were saying, like, trend following CTAs, that they feel that you hear this often, that there's just a beta to that trading strategy, and therefore it should be like a low cost strategy, right? And this is Corey and I know a lot of these managers well. We know what the returns look like, and there's a huge dispersion in returns amongst CTAs for many various reasons. Whether people try to raise AUM and more into the financials than commodities, there's plenty of reasons when you dig under the hood. But what I find interesting is I actually don't think their cost structure has come down because people think they can do it in some sort of easy beta form. I think the cost structure came down solely based on returns. So you had like a decade there before we got into, COVID or what's going on here in 2022, where, their CAGR was, on an aggregate level, like roughly 2% a year for a decade. And so therefore, that's why it's supply and demand. Fees are going to come down in that sense. I think I'm willing to pay fees in that space because I think it's, like I said, a broad dispersion of returns. So there is manager alpha in the sense that there is some red queen principle of running faster and faster to stay in the same place. And then you can put together a broad swath of those managers. And that's how you create a beta signal out of that. But every time I've seen somebody try to replicate CTAs in a easily accessible format, it's usually one, long only, where you're only getting part of the game, or they have to do everything else based on the restriction of 40 Act funds, or, whether you're trying to do an ETF, ETN, or mutual fund. they never are able to replicate the returns of true CTAs using managed futures. And Corey, you can push back on that if you want.
Yeah, I've never seen a ton of success there until I came across the DBI Managed Futures Strategy ETF, DBMF. Full transparency, I use it in some of our models. The idea there is to try to statistically replicate the return of the SocGen index, but the SocGen index is reported net of fees. So if you can replicate the returns without the fees embedded, just sort of the core beta of the returns without the fees embedded in the funds, you should be able to get SocGen plus 100 plus 200 bips. I think the fund has been very successful in delivering a high correlation to SocGen. And I think over the track record of the fund, as well as the SMA track record that I've seen those managers have going back, I think it was another 5 or 6 years prior to the fund inception, very high correlation to the SocGen CTA index, and they delivered that 100 to 200 bips of alpha on top just from cutting out the fees. So it's the only one I've ever seen be successful at it. Everyone else has sort of fallen down, but I don't think it's a bad approach. You know, you mentioned there's a ton of dispersion in that industry. So you really have two choices, in my opinion. You either believe you can find the managers that are going to outperform the dispersion, or you allocate across a bunch of managers. But when you talk to allocators, typically they're modeling that space using something like the SocGen CTA index as their sort of benchmark allocation, and then they pick a manager for that sleeve. Man, you can deviate by, tens of percentage points a year, positive or negative to that index, depending on who you choose. So I've always been a proponent of diversify the risks you don't want. I'm not going to know necessarily if I can pick a good manager. So I'm going to try to find managers who might play in different contracts, play at different speeds, rebalance across them. You might have a different view, though. You might feel like you can actually find good private managers who can do something truly unique.
Well, no, I mean, they have unique wrinkles, and then I put them together in the aggregate level on an ensemble approach because I want a beta signal out of that in general. And also, like, we don't recommend anybody on this podcast is not investment advice, but I also want to shout out my buddy Eric Crittenden at Standpoint, who does a great job as well. But like you were referencing, you're taking idiosyncratic risk if you're just taking on any one manager, right? It's always going to, even though it's a very systematized model, it's built upon their ideas of what the best parameters are for a systematized model. And I did notice in the comments, and appreciate it, with Mark asking, when are we going to talk about bonds? So yeah. I'll preface that real quick, though, with, we come up with a title for this 48 hours before, but the title's a loose representation of what we're going to talk about.
I don't think we came up with the title. I think Jack came up with the title. If I'm pointing over there, Jack came up with the title without even asking us, because you and I were both not paying attention to our group chat. So
that is completely accurate. So, but now, Corey, you're locked in. You got to do what the title says.
We got to talk about bonds, huh?
We got Corey, it's been, pretty much the worst year-to-date performance since 1990. You made me a fantastic chart. Let's add it to the stream. So this is actually a chart from Jim Bianco of I believe the Bloomberg Total Aggregate Bond Index, and it's going back to 1990. And in terms of we're the April 8th, it's the worst year-to-date performance in April, and also the worst performance ever. So that's the Bloomberg Aggregate Index. It includes treasuries, I believe mortgage-backed securities, high-yield investment grades. So it's more of the shorter duration, and the shorter duration has just been annihilated, as well as longer duration. And then also you've had credit spreads blowing out. This is a great chart by Jim Bianco, but this is the chart that you made for me, Corey, which is just the 30-year treasury, so extremely long duration. What are we?
I'd known you were going to put it on stream. I would have prettied it up. I would put a pirate flag on it. Okay, so what this is, by the way, is I took 30-year rates and I created my own constant maturity 30-year treasury bond index because I didn't have access to one when you asked me to do this. I probably could have gone into Bloomberg, but I was too lazy. So there's some assumptions here about you're buying an on-the-run treasury every month and then you're rolling every month. But what you can see in the black line is that's 2022 for this 30-year index, and it's actually not even the worst year-to-date start. I think, what did we say? 2021 was just as bad, if not worse. 2009 and 1980, I think, were the three that were worse. And 2009 is that one that dips all the way down there to 30% drawdown by sort of mid-year. So, yeah, look, bonds have been bad. A lot of people have sort of said, worst quarterly start in a long time. You look at core fixed income, you look at intermediate term treasuries. Yeah, it's bad, but it's not like so much worse than it's ever been. Like these are the type of drawdowns that happen. Now it'll be only with the benefit of hindsight will we know what it looks like in real terms. We can only sort of evaluate nominal terms, and Jason will tell you real is not real anyway. So I'm sure he has a whole spiel about that. But I've had a lot of people sort of say, oh, this has been a really bad start. There's sort of a so what aspect to me. Like, again, if you assume markets are efficient, which I think is a good starting hypothesis in most cases, like the past isn't telling you anything about the future. Just because we had a bad start doesn't mean we're going to have a bad rest of the year unless you have a view that implies that. So I don't think quoting like, oh, it was a bad start is really meaning anything other than it's just maybe a catchy headline.
Jack, I was letting you jump in if you had.
I don't know. I think it's definitely stands out. And as someone noted, a lot of the previous falls were from base effects. So, 2008 was a great year for bonds as equity sold off. It was a risk hedge. And so it was coming off from an elevated high in 2009, whereas 2022 now, as you correctly say, we're still in the correction phase of just the huge bubble in bonds from the summer of 2020. So after one of the worst years for long duration U.S. Treasuries, 2021, we have yet another. 2021 began extremely poorly. As you note, it got better from about, I think, April to December. But yet again, we have another huge drawdown. And it's not like there's no reading the tea leaves. Like you can tell it's because inflation is so high. And I like to say that in December, if you looked at inflation, CPI, about 6%, I don't know, Fed funds rate was at 0. And you said, you put them two on a chart and you said, this is kind of a bubble here. Fixed income is the market clearing rate for fixed income should be much higher given that inflation is so high. And you put that trade, or you posted that chart on Twitter, people would say, oh my God, Jack, it's so basic. Like it's so much more complicated. There's disinflation coming. Inflation destroys demand and we're actually headed to a recession. Bonds are going to do really well. That sort of simple analysis that when inflation is high and rising, you should not own bonds. So far, it's worked. I don't know if it will continue to work. I'm not someone who's super bearish on bonds now, but yeah.
Once again, you're using the sci-fi approach, extrapolating one quarter into the future, and that's how you're going to guess on how you're going to be positioned at. But it's something you said there.
I don't have a position in bonds. I don't have a position in bonds currently.
So, well, then that says a lot, right? And that's my point always is like, what if you're wrong, right? Like, so this was the issue I felt like this last week, and Corey referenced another piece I need to talk about is the idea of inflation and real inflation, et cetera. But part of it is like, what if you're wrong, Jack? That's what I'm saying. Like Corey and I have to like manage people's savings and manage their wealth. And it's not about being a hero trade and getting everything right and timing inflation or disinflation perfectly. It's about what if you're wrong and what is the relative value of the rest of your portfolio in case you're wrong, and what are the asymmetry of those trades, and how does, once again, for lack of a better term, what's the emergent effect of your portfolio? But talking about inflation, and Corey knows because I said something about real rates in our text earlier, is I said this on stage this week. Nothing annoys me more than somebody will come on stage and talk for 15, 20 minutes about how CPI is the worst measures they've ever seen. They have it's a terrible basket measure that they've changed it over the years. There's no way this to measure CPI, everything. And then they turn right around and in the next 15 minutes, they talk about inflation break-evens and real rates. And it's like, what are you using to minus? You're using CPI, so you don't get it both ways.
I hate to cut you off, but there's just something I have to add here. I've never heard someone say CPI is calculated incorrectly and inflation should be lower.
Exactly my point.
Not once in my life has anyone said that.
And once again, defining our terms is like we all have an individual CPI basket, basically. So what are we talking about? So I don't know what we're talking about. So when you say real rates and you're using CPI as your measure, and everybody hates CPI. It's like, what are we actually talking about? And that's my point is like, I'm never, and to be fair, what I'm actually saying is like, I'm not sure we could ever know what CPI is. And therefore we can never actually know what inflation is. And therefore we can never know what real rates are.
Correct. You can never know the true value of an equity, but there's no market for everyone's personal little, what's it called? PCE basket. You have to go on what trade. So even I'm not.
So that's a really good point, Jack. That is a really good point. But first, I need to address this comment, which said Jason's eyebrows are saying he's skeptical. Jason's eyebrows are always saying he's skeptical. Jason's never not skeptical. But Jack, you just said something I think is really profound, which is like you never know what the value of an equity is. There's market clearing price, but like if you tell me Coca-Cola stock is definitively the correct price, I won't believe you. I think prices are always wrong. It doesn't mean the market's not efficient, right? Prices can always be wrong, and you can't consistently make a profit on it being wrong because you don't know what the right answer is either necessarily, nor will the market approach your right answer. But there's a market clearing price, right? And so when we talk about like what is inflation, I think, Jason, you're right. We can come up with some statistical measure that might broadly say, hey, in the US, a basket of goods that may not be applicable to everyone rose a certain amount. But what we definitively can say is this was the market clearing price for tips. This was the market clearing price for treasuries. There's some liquidity issues there, but these are the market clearing prices at least. That means something. It doesn't mean that's what inflation is, but market clearing prices should tell you something.
Right, but tips is a hodl market with a low float that has some really
tips
big players in it.
25% of which is
So
owned
what are
by
you
the
gonna
Fed.
Yeah. So what are you going to use in that scenario? So but at the same time, I agree with what you said. And there's one thing though. We were running out of time. I really wanted to get to Zoltan, but I don't know what direction you guys want to head in.
I haven't read the new Zoltan piece yet, so can we save that for next week?
Yeah. So Jack, you choose your own adventure.
All right. Well, it's kind of related to Zoltan. It'll be a Zoltan, but this is in the beginning. You guys were talking about macro narratives and what's the trade. I think a lot of folks who talk about the end of the dollar system, that dollar-denominated assets will no longer be desired as reserves. I think the only way I get there is that there has to be a huge commodity spike that will force a lot of commodity traders to draw upon credit lines, and basically people will not be using the euro dollar system to create dollars from nothing outside the jurisdiction of the US dollar. They won't have recycled dollars that they have to pour back into US treasuries. But I think in that world of commodity prices exploding, the US actually, I think, does okay because the US has a lot of oil, natural gas, huge wheat, I think biggest corn grower in the world, and Europe is going to be absolutely, shit out of luck. So I think in that world, I actually think the DXY goes higher. So even though it's the death of the dollar, DXY goes higher.
You know who had a really interesting take on this was but Jason, you'll like this. Our friend Mike Philbrick from Resolve. He and I were in the gym the other morning together chatting, and he mentioned this idea of the North American risk parity portfolio, which is just blending U.S. equities with Canadian equities. And the idea basically being the Canadian dollar and Canadian equities are so resource heavy, and the U.S. dollar is not, nor are U.S. equity markets, that when you blend them together, it creates a surprisingly resilient portfolio because you're getting a ton of that commodity exposure implicitly. Now, commodity equities are not commodities necessarily. There's a whole bunch of other issues in there, but I thought it was sort of a cute idea, right? Of just saying, well, I'm just going to buy North America instead of just the US.
Yeah, the first thing that would pop into my mind, I was trying to remember who said it the other day, is like the Canadian stock market is just rife with fraud. Like the only thing outside of maybe the Canadian stock market for fraud is maybe Mormon CEOs. I didn't say that. I'm just repeating it. So I just couldn't help myself. But I really like that, and I like the way Mike thinks. So I thought that was an interesting thing. But to push back on Jack a little bit too, what I want to hear actually is from Perry Merling, which is Zoltan's writing partner and his mentor, who actually disagrees with whatever Zoltan is saying about Bretton Woods 3. And then your homie that does your other podcast with you, Wang is Joseph. Shout out to Joseph. He's he had the same consensus kind of idea, just like the idea that the banks are the credit risk of commodity producers and their effects of trying to offset their risk, and borrowing from banks is like that's an unlimited supply because it's a very low risk trade. So that's part of it. But when we don't want to get into Zoltan because like Corey said, he hadn't read it. And actually I haven't had a chance to read it either, so I shouldn't speak out of school. I've just listened to a few podcasts around it while I was walking or in between things and getting ready. So I haven't read it either. So I'll go back on that. And then Jack, I was covering my eyes to see no evil when you quoted the Dixie. Like I just wanted to lose my mind. Speaking of let's define our terms. Like we're talking a USD euro spread. We're not actually talking about the US dollar.
Yeah, right. Well, it's I think 58% of the euro. So I was aware of that mistake when I was saying that. Like if you're saying the Eurodollar system will collapse, ergo short the DXY or short UUP, an ETF that's tied to it. Yeah, I think that's very flawed because 58% is tied to the euro, and I think in the scenario of a commodity price spiral that makes what we have seen so far look like nothing, then I think Europe will not do well, and I think the DXY would go higher. So yeah, and then oh, you're bullish on the dollar, like relative to what? Turkish lira? Actually, the Turkish lira paper yields like 20%. So
well, right, and then you're also I was saying you're seeing an interesting play in CTAs right now, which is that they're long commodity currencies versus the dollar and short, European currencies versus the dollar. You got this interesting intra-currency spread that CTAs are playing very actively, which is all sort of related to like an inflation trade in theory.
Yeah, and then part of that though is like Jack's extrapolating the future for like an inflation spike, and we kind of talked about it on the last episode. Is like when you have these CTA trend followers, when they're having large profits in their P&L, you've now absolutely opened up the left skew. So we could see this mean revert just as quickly, and none of us know the future on that. I want to give quick shout outs to Rajiv said, how about Zoltan wants to sell his newsletter? Absolutely perfect, because that's what we talked about at the beginning. And then so once again, having divergent opinions, also sell it. And then there were some other great comments here. I'm trying to find them too. Is like Sean said about this is the Peter Zeihan view of the world with that North American risk parity portfolio, and there's a lot of talk about that at this global macro event this week. And once again, the exorbitant privilege of the U.S. is much more natural resource driven and defendable ocean borders on either side. And so that was a lot of people were talking about that this week.
I like this Mike Harris comment. I don't think anyone understands the Zoltan reports. I think that's 100% true. I normally have to read them 3 or 4 times to understand what he's saying. They
used to. Oh God, I'm losing my mind right now. There was a trope that used to be in philosophy that the more obtuse you made it, the more harder to read. As long as you had the right people that liked you, then that meant like you were a great thinker. So I'm not saying Zoltan is or isn't. It was just reminding me of that. I also, by the way, gonna give a quick shout out. I was thinking in my mind of Resolve Riffs is about to have Rohan on. I think they probably started like 2 minutes ago. So I understand if you want to leave here and go watch that. But Rohan had.
Don't say that, Jason. Come on.
Yeah, well, that's life, Jack. Come on. It's Rohan had the put out the trying to get eCash into. They put out the proposal for eCash, and the idea is Rohan is understandably very dystopian on CBDCs and stablecoins. So he wants to preserve this anonymity we have with the cash transaction. So he's trying to come up with a proposal for eCash where, you have all that anonymity cash. It's not on ledger like a CBDC or any of our stables or our BTC. So you could still preserve a little bit of anonymity and freedom if we can create a digital cash system that represents our current physical cash system. And I think that's incredibly important when we're talking about where crypto is heading. And both of you might disagree with me on this. I don't know. I have no idea.
Can I? This is not. We can't go into this now because we're already over. But topic for next week. This blew my mind when I saw this. So I think Jason, you and I talked about how going into crypto, Terra Luna decided to back their stable coin using Bitcoin reserves, and then recently announced a partnership with Avalanche Chain to further back their treasury with AVAX token. And like part of me is, I don't know, somewhat dumbfounded by all this. Like you're backing a stable coin with governance tokens that still don't really have any value, but it's like, no, we're just going to keep adding governance tokens that are like really, there's no true economic value to any of this. And somehow it works until it all doesn't, is my guess. It's just a fascinating time for all this financial, I'm going to use the word engineering, but probably, I don't know, magician ship. I don't know what the right word is there.
Exactly.
Like,
well, and part of the comments,
wizardry.
by the way, from Sean and Sleppers, which is great. It's like, isn't this Monero or other things where you could use tumblers, etc.? Kind of yes and kind of no. I mean, it's still on chain and it's on ledger going into the tumbler, and tumblers are still on chain as well. So I don't get me wrong. Like, read Rohan's proposal yourself. But the idea is like this is something easier for everyday people to use, and whether it's using hardware or some sort of card-like system, the idea is trying to keep it off any sort of chain to make it untrackable.
Corey, the only reason I know anything about that is because I talked about it with Byron, who writes the Blockworks newsletter, as well as Mike Ippolito, co-founder of Blockworks, on an episode that airs tomorrow, on Saturday the 9th, on Blockworks YouTube channel. And I have to say, yeah, I think, traditional TradFi history is replete with examples of financial contagion, where, in 1929 there were essentially trusts that were basically like kind of investment pools, ETFs, sort of, and they owned each other. And then in 2008, like the banks owned the liabilities of each other. Enron, it lent stock that was securitized by its own stock, so that when it fell, it had to do more. And I feel like, yeah, if you look up crypto market prices, and you'll see on a day when Bitcoin's down 5%, like pretty much, most crypto things are also down. So if Bitcoin goes down, Avalanche will likely go down. So I think there's not a lot of hedging, tail risk hedging by downside convexity. It seems like it's kind of short convexity.
Well said, Jack.
I think that's
Jason's like, Jack, that's the first thing you said this entire podcast. That isn't stupid.
Just when I think you can't get any dumber, you go and do this and totally redeem yourself. Once again, this podcast is for educational purposes only.
You keep saying educational. Entertainment, my friend. I don't even know if I'd call this education.
I don't even know if I'd call it entertainment. Edutainment. And at least Jack, look, he's got the scroll using. He figured out the crawl on the bottom at least, so he is getting better. So we'll give him that.
I'll have
Corey
to
can play the outro.
And Corey, once again, I guess we'll get to return stacking next week. Stay tuned. Thanks, everybody. The comment section was on fire this week. We really appreciate it. We appreciate all you joining us live, and then everybody watching the replay. You can find us at C Hoffstein, at Jason Mutiny. Jack, what's your Twitter handle?
At Jack Farley 96. Please subscribe to the Blockworks YouTube channel, and the most important plug of all is, please, you have to subscribe to Jason's newsletter. He writes every week about very topical. He's got a lot of macro. He's a big thinker. He does a bird's eye view. Sometimes it's a little hard to get the trades and the time horizons, but yeah, when I read Jason's work, my brain just feels like, I see it. I see the picture. I see the piece.
Mind expanding.
And I love in the comment, there was not one piece of investment advice on this podcast. That's how we do it every time. You're welcome.
Thanks, everyone.
Thanks, guys.